Understanding IPOs, a deep dive into public offerings and their impact on investors. Welcome to StockRhino. You've heard of companies going public or launching an IPO, but what does that really mean? A public issue is the process through which a private company offers its shares to the general public for the first time, opening doors for investors and unlocking growth capital for businesses. In this video, we'll explain what a public issue is, its types, process, advantages, and how you can participate as an investor. What is an IPO? A public issue is when a company raises money by selling its shares or securities to the public through a stock exchange. It allows companies to move from being privately owned by founders and early investors to publicly traded, where anyone can buy or sell shares on the open market. Why companies go for a public issue? Companies issue shares to the public for several reasons. To raise capital for expansion, R&D, or acquisitions. To repay loans or reduce debt. To give early investors and founders an exit route. To enhance credibility and brand visibility. To create a liquid market for their shares. Essentially, it's a way to turn ownership into opportunity. Types of public issues. There are three main types of public issues in India. Initial public offering, IPO, when a company offers its shares to the public for the first time. Example, Zomato or LIC's first ever listing. Follow-on public offering, FPO, when a listed company issues new shares to raise additional funds. Offer for sale, OFS, when existing shareholders or promoters sell their shares to the public without the company issuing new ones. Process of a public issue. The process of launching a public issue involves several key steps. Company appoints merchant bankers and legal advisors. Files a draft red herring prospectus, DRHP, with SEBI for approval. After approval, the company announces the issue date, price band, and lot size. From planning to listing, the journey takes around 36 months. Categories of investors. In a public issue, shares are reserved for different investor categories. Retail investors up to 2 lakh application limit. Non-institutional, HNIs, high net worth investors. Qualified institutional buyers, QIBs, like mutual funds, banks, and insurance companies. This ensures fair participation across investor types. How pricing works. Companies can use 2 pricing methods. Fixed price issue, a single, pre-decided price per share. Book-built issue, a price band is offered, and investors bid within that range. The final issue price is determined based on overall demand, balancing company valuation and investor appetite. Example. A company issues 1 crore shares with a price band of 100,120. If investor demand is high, the final price may be 118. The company then raises 118 crore and lists on the exchange. Investors who were allotted shares can sell or hold after listing. Advantages of a public issue. Benefits of a public issue for companies. Access to large-scale funding. Public trust and visibility boost. Liquidity for founders and early investors. Enables future fundraisers more easily. And for investors, it's a chance to become early shareholders in growing companies. Risks involved. But like every investment, public issues have risks. Market volatility may affect listing price. Companies can underperform post-listing. Oversubscription might mean no allotment for retail investors. Hype or overvaluation can lead to short-term losses. So always research the company's fundamentals before applying. How investors can apply. Investing in an IPO or public issue is simple. Use ASBA, application supported by blocked amount, via your bank account. Or apply through your brokerage or UPI app. Your money stays blocked until allotment, only deducted if shares are allotted. After listing, shares are credited to your demat account. Want to learn more? Visit our website.